Hello, everyone. How is everyone doing today? Welcome back for today's third live streaming. I hope everyone is having a great time and I hope everyone is prepared for the festive season of Christmas. But before talking about Christmas and all the festive moods that people are going to be in, we have something important to cover today, right? Today we will be focusing on our course number three. So, how many of you are interested for today's third live streaming session? Let me know in the comment box. All right. So, we have been focusing on providing you with valuable education content since the past couple of days, correct? We had been talking about trading logic, where we had dwelled more deeper into in terms of understanding how the markets have been functioning, so on and so forth, right? So, we have discussed the psychological aspects when it comes to trading logic. How many of you have attended all my education stream sessions where we had been focusing on trading logic? If you have attended, let me know in the comment box below. All right. So today we will be focusing on the technical aspect. All right. When it comes to trading logic, how many of you are excited? Come on, let me know in the chat box. All right. So let us start with today's third live streaming session. All right. So starting with course number three, in the previous courses, like I had mentioned, we had been focusing on the psychological aspects, correct? When it comes to to trading logic. Today we will be focusing on the technical aspect, correct? And mastering the technical aspect of trading logic can definitely, make certain of you achieving financial prosperity. So we will be starting with a focus on the technical aspect. All right. So moving on, let me ask you, how many people have been trading in the financial markets? And if you have been trading in the markets, could you please let me know who are the market participants in the financial markets? Are you aware of the participants in the financial markets? If yes, let me know your answers in the chat box. All right. All right, so we are having answers where people are saying yes, buyers, sellers, traders. All right, so everyone is answering well. So we will be first and foremost letting you know in terms of who are the market participants, right? So the market participants are generally comprised of the following: we have institutions, we have large investors, we have state owned funds, we have mutual fund companies, we have listed companies, as well as we have small to medium sized investors. I'm sure everyone is paying attention. All right, so thank you for all your answers, but these are the major market participants, correct? When we are talking in terms of the financial markets, let me repeat it once again. We have the large investors, state owned funds, mutual fund companies, listed companies, and small to medium sized investors, right? It may sound complex, but initially you have to understand that when it comes to the financial markets, there are typically two kinds of people, right? In the financial markets, anyone aware which are the two kinds of people in the financial markets? Let me know your answers in the chat box below. So in types in the two types of people that are in the markets, there are the first kind of people who give money in the financial markets, right? Who lose money when it comes to the financial markets. And the second type of people are those that are making money, right? That make money or that take money. How many of you are understanding this particular point, right? If you do understand, let me know your answers. Which category do you think you are falling into? Do you think you are the type of people who makes money, or who loses money, or are you the kind of people that takes money or makes money? Let me know your answers in the comment box below. Correct? I can see many people are saying, yes, Harsh, we are unfortunately losing money majority of the times in the markets, and I completely understand, right? So I do understand that people do have a tendency majorly of losing funds, right? Or losing capital. So most investors constantly lose money in the markets despite their success in other industries. How many people understand this crucial point? Very few people are willing to admit that they are, losing money. People try to boost and show a false facade by telling that they're making money, when statistics have been reporting, that majority of the people who enter into the financial markets are losing money. So based on the two kinds of people in the financial markets, one are those that are making money, and they are the other kind of people that are losing money, right? And we unfortunately, or majority of the people who are into the financial markets, are those ones that are losing money. Correct? Now let me share some of the characteristics of people who lose money. Correct? Think about it. If you would know how to buy and how to sell, shouldn't you be making money overall? Shouldn't you be profitable in the markets? Correct? If it was as simple as buying and selling correctly in the markets, overall people should be making money. But that has not been the case. Correct? People have been losing money. People have been losing money in the financial markets. So we need to focus on the results, right? We need to understand what is the reason, why is it happening that most of the people who are entering into the financial markets are losing money. Am I correct? If you have any doubts, or if you have any of your opinions, you can let me know in the comment box below. All right, do let me know in the chat box. So when things don't go well, all right, we should review whether the issue lies in our skills, methods, risk control, capital management, or position sizing. It is very crucial to understand the reasons of what influences us in terms of taking the wrong decision when it comes to the financial markets, correct? So I hope people are understanding. It is not that hard in terms of when people say, oh, the markets are so hard to make money, or we are losing money when it comes to the financial markets. If you start to think based on trading logic, whether it is the psychological aspects or whether it is the technical aspects, it is more to do with a self-talk in terms of how can you talk within yourself and find out the root causes that are leading you to lose money, because majority of the people who trade independently are on the wrong side of trading. That is, they have been losing money. Correct? Now we will be basically talking in terms of uh, what should be good buying and selling, right? What do you mean by good buying and selling? Anyone who would want to answer in the chat box, let me know your answers. So what do you mean by good buying and selling? Let me know your answers. What is your definition of good buying and selling? So as you can see on the screen, good buying and good selling simply, it means, or the basic understanding is buying low and selling high. You can look at the diagram which has been showcased on this particular PowerPoint page, and it is the basic understanding of what is meant by good buying and good selling, right? How many people are understanding? If you are understanding and if you agree, let me know in the chat box below. All right. So ask yourself if the profit in the stock market comes from price differences. So I hope everyone has understood what do you mean by good buying and good selling. Good buying and good selling, put in simple terms, is selling high and buying low. When the markets are at a lower price, That is the tendency or the right aptitude or the right way of entering markets to make money. When the markets have risen to a high point, you want to close the market because the prices have appreciated. So you want to buy low and you want to sell high. That is what is meant by good buying and good selling. All right. Now ask yourself in the profit market. Ask yourself if the profit in the market comes from price differences. If you think that the profit that are being generated in the markets comes from price differences, let me know your answer. If yes, you can write yes, and if you think no, you can write no as well. All right. Now, many of us, I'm sure, will be replying that yes, Harsh, it is correct that profits are generally made in the markets based on price differences, right? And it is a fact because we all believe in the same analogy that yes, there is the differences that lead to profits being generated in the markets. And it is true. Everyone who has this outlook in terms of profits that can be generated in the markets are based on price differences. It is true. We all aim for the same thing, and that is profit generated from price differences. Correct? I hope people are able to understand. All right, that is good as well. So we aim to be profitable, right? Trading is based on probabilistic, right? It does not require perfection, but rather a strategy for uncontrollable situations. How many of you agree with this particular point? If you do agree, let me know in the chat box below. All right, let me repeat it again. Trading is probabilistic. It does not require perfection, but rather a strategy for uncontrollable situations. So I hope everyone is understanding, and it is very basic yet very powerful. Come on, the concepts that we are sharing might sound simple and easy to a majority of you, but ask yourself, if it was so simple and easy to understand, why aren't you being profitable in the financial markets, right? It is a very important question to think about. So everyone is aware of Mr. Warren Buffett, right? How many of you are aware of Mr. Warren Buffett? If yes, let me know in the chat box below. So everyone should be aware of Mr. Warren Buffett's infamous quote, and that states that there are two rules. Rule number one: never lose money. All right, and rule number two: always remember rule number one. How many of you have heard this particular quote from the business magnate, from the trading legend Warren Buffett? If yes, let me know in the chat box. So when Warren Buffett says not to lose money and reiterates rule number two by saying to remember rule number one, there is something that is important in these particular quotes that Mr. Warren Buffett has mentioned, right? Now let me ask you a question. How many of our audience members who are attending this session are losing money? Let me know in the chat box. How many of you have been losing money in the financial markets? So people are saying, yes, we are losing money in the financial markets. Let me ask you a more straightforward question, right? How many are losing between 10 to 20% of their trading accounts annually? Let me know your answers in the comment box. How many viewers and clients in the audience of our live stream sessions are losing 10 to 20% annually? Let me know your answers below. Are you losing between the range that I have mentioned, that is between 10 to 20%, or are you losing more than 20%? Let me know the answers for both in the chat box below. People are saying yes, we have been losing quite a considerable amount of money. Some people are losing 5%, some people are losing 10%, some people are losing 40%. It is true, right? because many people, the statistics have been showcasing again and again that people overall have been losing money in the markets, correct? So how many of you have been losing between 10 to 20%? Let me know in the chat box, as well as how many of you are losing beyond 20%. Let me know that in the chat box as well. We have been getting answers, and based on the answers, the numbers have been quite surprising, right? But irrespective whether you are losing within the range or whether you are losing beyond the range of 20%, the outcome is the same, correct? And that is losses or losing in the financial market. Do you agree with me on this particular point that I'm talking to? If you do agree, let me know in the chat box. All right. So I hope everyone is getting a clearer understanding. We are trying to underline the factors that are responsible for the losses, right? Why people who enter the markets initially have huge aspirations, initial intentions, but as and how time goes by, majority of the traders and investors are just running to get their accounts back to break even, right? Because they have been in significant losses, and all they care about is just how to recover the losses. So there has to be a shift in the mindset, correct? How many people are understanding this point, right? Irrespective whether the losses are minimal or the losses are huge, right? Massive, the ultimate outcome is always the same, and that is people are losing money in the financial markets, right? So moving forward, we will be focusing on 8 principles that you should be memorizing thoroughly, correct? 8 principles that you should be memorizing thoroughly, and they are going to be the key to financial success, right? So we will be talking in details about the 8 principles, right? Let me show you the 8 principles. So the 8 concepts or the 8 principles that you must memorize thoroughly are shown on your screen. First, buy without urgency. Second, sell without greed. Third, cut losses swiftly. Fourth, diversify cautiously. Fifth, embrace volatility. Sixth, recognize market cycles. Seventh, prioritize probability. And eighth, understanding reversal patterns. I'm pretty sure everyone has been aware of the first 4 concepts or principles, correct? I'm sure everyone is aware based on the previous live stream sessions that we have been providing to you. We had covered in greater detail about the first 4 concepts and principles, right? So we had talked about buying without urgency, selling without greed. One second. Buying without urgency, selling without greed, cutting losses swiftly, and diversifying cautiously. Right. So we had talked about the issues, right? How people do the opposite, where they buy hastily, they sell very lately, they don't prefer to cut losses quickly, and they prefer to diversify too massively, right? Over diversification. Those were the issues that we had discussed in yesterday's third live streaming session. Today we would be focusing on the next 4, right? Which are going to be embracing volatility, recognizing market cycles, prioritizing probability, as well as understanding reversal patterns. How many of you are excited for learning in detail the 4 additional concepts that will be important for your financial success in the markets? If yes, do let me know in the chat box. All right. So starting with the first point, let me start with the first point. First point is going to be embracing volatility, right? Volatility is constant. Now, how many of you are aware of what volatility is? If you do know, let me know in the chat box below. I'm sure most of you would be aware in terms of what volatility is and What, okay, so what is your definition of volatility? If any one of you knows the definition or the understanding of volatility, please let me know in the chat box. So when it comes to volatility, everyone is aware of the market charts, right? Whether the markets are going up, whether the markets are going down. So the markets are full of volatility, prices oscillating or moving in ranges, prices shooting in in directions, in particular trends, whether it's an uptrend, downtrend, or sideways. So there has been a lot of volatility, right? So when you zoom out and you look at it from a bigger perspective, you can see that there is a lot of movement on the chart, whether you are looking at a line chart, whether you are looking at candlestick pattern chart, but overall you are surely observant in terms of volatility in the markets, correct? How many of you are understanding what I'm saying? If you are understanding, let me know in the chat box, correct? So everything fluctuates. You have to understand that volatility is the only thing in the markets that is going to be constant, right? Many investors have been making the grave mistake of buying high and selling low. How many of you have been buying at higher prices and selling at lower prices? Let me know in the comment box, correct? Many people do this mistake, and that is where they create problems. We need to understand volatility is crucial, and we also need to understand that by placing trade, by taking the advantage of price differences, we can be using it to our benefit. So first and foremost, for instance, for example, if a stock is at 5 rupees, right, you should be selling it when the stock goes to 8 rupees, correct? It's a hypothetical example, but it is very basic yet very powerful, right? We generally should be having the outlook of buying a stock, for example, if it's at 5 rupees, and later down the lane, if the prices have appreciated in value to, for example, 10 rupees, that is how we should be utilizing the power of volatility. But many people, on the contrary, are doing the opposite. They buy when the price of that stock is at 10 rupees, and when the prices are correcting and have fallen or come down to 5 rupees, that is the time that exit their trades, right? And if you close your trades, if you're buying a particular stock at 10 rupees, and if you're closing that trade when it goes to 5 rupees, you are making a loss of 5 rupees, right? So you have to understand that volatility is the only thing that is constant, and we need to utilize the power of volatility to our benefit, correct? How many people understand this? Does any one of you know what causes volatility in the markets? Could you let me know some of the reasons why there is volatility in the markets? Because of fear, greed. Okay, so people are giving me answers, but the main important factor is based on supply and demand, correct? How many of you have heard the term supply and demand? Let me know in the chat box below. So supply and demand is the main reason why there is volatility in the markets, right? What is supply demand, right? Supply demand is nothing but the movement of price based on on the participants' emotions, correct? Whether the participants are feeling greedy or feeling fearful is indirectly or directly connected to volatility in the markets, correct? So for those of you who have answered greed and fear, it is correct, but that is the underlying aspect, right? The main factor is supply and demand, correct? That is driven by participants' emotions. If you agree with me, let me know in the chat box, all right? All the market movements that you see on the charts are boiled down to human emotions, right? Fluctuations in human emotions. When people are greedy, generally people buy when the prices are appreciating in value. When people are fearful, when the markets are falling, people are fearful. So it is all to do with the fluctuations of human emotions that causes price volatility in the markets, and we need to understand to use the benefit of volatility in our favor, right? We need to buy at cheaper prices, at lower prices, and we need to sell at higher prices. and not vice versa, where we buy at high prices and we need to sell at lower prices for the loss. How many of you are understanding? If you are understanding, let me know your answer. All right. Now, moving on to the next point, which is going to be the sixth point. We will be talking about recognizing market cycles, right? How many are aware of what is a market cycle? Does anyone know what is the meaning of market cycle? If yes, let me know in the chat box below. Because many people have confusions of what is a cycle. Are we talking of a bicycle? Are we talking of a tricycle? Not at all. We are talking about market cycles. So think of stocks as flowers. There are certain flowers that blossom in certain seasons, right? While some might be blossoming in some seasons, the other flowers are getting dull in the same season. So what do you mean by market cycles? Not all stocks rise and fall simultaneously, correct? I hope you agree with this particular point. Some stocks that have been surging earlier might be having a decline currently, and vice versa. There might be some stocks which have been undervalued or have been, drastically reduced in terms of their pricing, but they have massive potential to move to the upside. So you have to understand that the entire market does not work exactly the same. There are different stocks in the markets, and every stock has its own characteristic, whether it is based on sector analysis, whether it is based on industrial analysis, whether it is based on certain policies that have been implemented by the government. So there are many factors when it comes to market cycles, but the underlying crux remains the same. Not all stocks appreciate or depreciate in value simultaneously, right? Some stocks appreciate and might start to decline. Some stocks are, declining since the last couple of months, weeks, days, and they start to appreciate in value. So every stock has a unique characteristic, correct? I hope everyone is understanding. If you do understand, let me know by saying yes in the comment box. All right. So people needs to understand how we can utilize the power of recognizing market cycles to our advantage, correct? So just holding on to one stock indefinitely does not guarantee you success in terms of profitability in the markets. Let me repeat that question. Holding on to one stock indefinitely is not a strategy that people should be focusing on. One stock holding indefinitely does not guarantee success in the markets, correct? Flexibility is the key for us, which includes small to medium term traders. Flexibility, how we can take advantages of stocks that are undervalued. Remember, we talk a lot about intrinsic value, fundamental investing, or technical trading. All the terminologies are focusing on one aspect, and that is how we can identify certain market conditions based on certain stocks that are giving us a fair value, and we expect the value to increase in the future, right? That is how money is made in the financial markets. Now, moving on to the next topic, to the seventh concept, right, or principle, and that is going to be based on probability reigns supreme, right? How many of you are able to understand this particular topic? If you have heard about this topic, or if you understand this particular topic, let me know in the comment box below. All right. So typically means that there is no foolproof strategy that works 100%, right? How many of you agree with me for this particular topic? If yes, let me know in the comments below. It is important to understand now, no working strategy in the entire world is foolproof. What do you mean by foolproof? Does it work 100% of the times? There is no strategy as such, right? Knowing when to exit is crucial. All right, let me repeat it. Knowing when to exit is crucial. What's more important is achieving consistent profitability through compounding, right? We had talked about Mr. Warren Buffett, even a big and a well-known celebrity, a financial market celebrity like Mr. Warren Buffett's trading success revolves between 60 to 70%, right? even the biggest influential trader in the financial markets is still not making 100% profitability. He is still making between 60 to 70% profitability in the financial markets. Do you agree with me? Have you heard about him? And are you aware that this is the reality, right? No one in the markets has been consistently making 100% returns on every trade that has been taking. Markets are based on probabilities. Markets are not based on certainties, right? So even if you can be attaining between 60 to 70% profits in the markets, you would be called as a trading legend, because Mr. Warren Buffett is making the same returns, and he is considered to be a trading legend himself, right, in the markets. So you need to be aware of this particular point, right? Always consider the probability of success even before you enter a trade. All of us are so busy and caught up in the rat race of taking trades so that we can make money consistently, that people often overlook the major underlying asset, and that is about focus, concentration, and mindset. So that is very important to understand, and most importantly based on this point, which is probability, right? Markets are based on probabilities. Markets are not based on certainty. So probability reigns supreme. Probability is the king when it comes to the financial markets. Rather than thinking about making money on each and every single trade, you have to understand how can you take more number of trades and be net positive, because in trading there is a common saying that goes by 1 plus 1 plus 1 is not equal to 3, but 1 plus 2 minus 1 plus 1 minus 1 plus 2 minus 1 plus 2 is equal to 3. So you have to understand, in trading there are going to be winners and there are going to be losers. So there is never a straightforward calculation in terms of every trade that has been taken in the markets shall be making 100% profitability, right? It is always going to be inclusive of winners and losers. So you will be making and you will be losing, but we have to make sure that overall, based on our net returns, we should be positive, right? Or we should be making profits. I hope people are able to understand this. So enhance your certainty and reduce your uncertainty, right? People needs to be aware that not just to be focused on 100% profit target level or profitability, but net positive, right? So there are many factors which include industry selection, government support, a company's position within its industry can add your odds. So the higher the probability, or the higher the confluence factors that we can generate for a particular for a particular form of trading, the more probability for us to make money in the financial markets, correct? How many of you agree with me? If yes, let me know in the chat box. The whole focus lies on when to buy and when to sell, right? So remember, the more you practice, the more fluent you're going to become when it comes to the financial markets. As you grow as a trader, your profit potential will also increase. Remember, everyone has to start from somewhere. Anyone who has been achieving the heights of financial success had to start from somewhere, right down the line. People have to put in the hard work, people have to put in the energy, the focus, the dedication, the mindset, and only after time, right? It requires patience and it requires good amount of time. Only if you can sustain and endure through the ups and downs can you be making potential high profits in the markets, correct? How many of you agree with me? If yes, let me know in the chat box below. I had to get inform you about a very important point, that even if you're comparing our Indian markets, correct? The Indian markets over the last decades, have been on a bullish trend. Am I correct? If I'm correct, let me know in the chat box. Let me repeat what I've said. We have been observing that the Indian share market has been in a bullish sentiment, right? Or in a bullish phase since the last couple of decades. But still, even when the markets are being bullish, Why are 90% of the traders who are in the markets losing money? Think about it. It is a very important question that you should be thinking about, correct? So you have to understand why. It is because quality assets flow into the stock market, attracting wealth investors. Focus on solving problems and enhance your success rate. Even though the markets have been appreciating in value, why is it that people are losing money, right? It is not a small percentage. We are talking about a very sizable, right? A 90% of the traders in the markets, in the Indian markets, are losing money. So there is something deep to think about it. It all boils down to probability. How can we garner more confluencing factors that can help us in becoming informed and sharp traders, right? All boils down to probability, and it also boils down to being net positive. Let me reiterate the sentence. It all boils down to probability. Nothing works 100% of the time, correct? We need to look at the pros and cons. We might be having winners, we might be having losers, but net positive is what we should be focusing on. Correct? How many of you are understanding? If yes, let me know in the chat box below. All right. So people are saying, yes, Harsh, we are understanding. And we would be talking about the eighth and the final point for today's live stream session, right? And that is going to be about understanding reversal patterns. How many of you are already aware of what is a reversal pattern? Right? Many people do get caught up even in the notion of trying to catch the bottoms and the tops, right? How many of you have heard the term catching the bottoms and the tops, right? It is a very common notion that is being used in the financial markets, where we expect, or we feel that we need to catch the tops and the bottoms, right? What do you mean by tops and bottoms in the market? When the prices are fluctuating, the pricing are creating tops and bottoms, right? From where the prices are turning. So every time people think that the only way to make money in the markets is to catch the top, right? Or to catch the bottoms. You want the moment the price turns from the bottom is where we need to enter, and the moment the prices goes to the top is where we need to exit and close our positions, right? How many of you have heard this particular concept? If yes, let me know in the comment box below, right? So this is a very natural law and many people fall for this, but you have to understand that it is not important to always know the exact highs and the exact lows, right? Many people do think it is important. How many of you think it is important to identify the exact highs and exact lows? If yes, let me know in the comment box below. So the answer is, people are saying yes, but unfortunately the answer doesn't reside with yes. We do not have to be constant in catching the highs and the lows. We don't need to be at the extremes. We need to be close to the extremes, right? There is a difference. We don't want to be precisely at the tops and bottoms or at the extremes. We want to be closer to the extremes, right? So significant declines may signal a turnaround, right? When the prices are turning or are declining, there is a potential for prices to turn. And when the prices are steeply rising, there is a potential for another turnaround. So in simple terms, when people have the focus or rational towards catching the tops and the bottoms, it is misleading, correct? We should be aware that yes, it is important to be aware of the tops and bottoms, but we need to be just close enough to the tops and bottoms, right? Like I had mentioned to you, significant declines take place, and that may signal a significant turnaround. Similarly, if there are steep rises in price, that might indicate a reversal where prices would be expected to fall down, correct? This is the common rule in terms of understanding reversal patterns, right? There are many candlestick patterns, line chart patterns, and so on and so forth. But again, let me reiterate, it's not about catching the precise highs and lows, but trying to identify and being close enough to the highs and lows, right? How many of you have understood? If yes, let me know in the chat box below, right? People are saying, yes, Harsh, it is true. Everyone is learning, and I'm very grateful that people are paying good amount of attention, right? So these are the 4 points that we have been covering, and that is, very crucial in terms of understanding the technical aspects when it comes to trading logic, right? So by embracing the 4 principles, making money becomes straightforward, right? So how many of you have had a good amount of knowledge, and how many of you think that I have been able to add value based on the trade technicalities when it comes to trading logic? Let me know your answers in the comment box below, correct? It is very important to understand we are focusing on the psychological and technical aspect of trading logic, and how enhancing our trading logic, whether psychological or technical, can make us better in terms of trading. And getting better in trading eventually, resonates with making good profits in the market. So I hope everyone has had a great understanding for today's session. We focused on the 8 core principles, which four principles had already been discussed in the previous sessions. The next 4 principles had been discussed, which were nothing but embracing volatility, recognizing market cycles, probability reigns supreme, and understanding reversal patterns. So these have been the 4 concepts or principles that we had talked about, and we had talked in detail about the reasons, the rationale, and how we can utilize the benefit or the advantages of the 4 principles to our to help us in generating consistent profits in the financial markets. So make sure that you are attending my live streaming session that will be taking place tomorrow. Yes, tomorrow is the day of Christmas. I wish each and everyone who is attending this live streaming session a Merry Christmas as well as a Happy New Year, right? So I will be seeing you tomorrow for the third live streaming session. Until then, have a great day. I'll see you tomorrow. Bye bye and take care. See ya.